No way. Did you see this?
See what?
P. Diddy and Sam Bankman-Fried are in the same unit of a Brooklyn jail cell right now.
Are you serious?
Can you imagine the parties that are going on right now between the two of those guys?
The question is, do you think they're sitting there having conversations about, hey, when we get out, what are we going to collaborate on?
Oh, geez, yeah, that's going to be the collaboration of the century when they get out. It's going to be amazing.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 66 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'd like to say we're all together this episode, but we're not. We lost AJ. AJ's gone. We had a little mix-up. We thought he was missing 2 weeks from now, but he just all of a sudden let us know last minute that he's not going to be here. And so we had, what was it, last episode? A couple episodes ago, we based our one of our premises off of this podcast that's called One Rental at a Time podcast. And we said, oh, how smart these guys are. They're making great points. We agreed with 95% of what they said. So we're like, why don't we go and try and grab one of these guys and be a guest host for us? So we did. We reached out, and Michael Zuber was available to jump on this podcast. So along with me, Jay, and Mauricio, we have Zoobs joining us. How's it going, buddy?
Man, I appreciate the opportunity. I got a lot of great feedback from folks that sent me your link and sent me the video with the agreements and disagreements. I thought you guys did a wonderful job. This is kind of a full circle moment for me because, when I was writing for Bigger Pockets way back in the day.
Oh, no, you're not going to give one of these like, oh, Jay Scott, I read his book.
No, even before that. I knew Jay Scott when he was flipping 1, 2, 3 flip. So I knew Jay before he was writing books. I've actually never read one of Jay Scott's books, but I did read 1, 2, 3 flip. I read that a lot. So
I don't need anybody to read my books. Just buy them.
So Zuber, why don't you tell us a little bit about yourself so the audience can get a feel for what you're about.
Yeah, so I guess my story is probably a lot like the audience. I was a W-2 employee. I thought you went to college, you got a good job to make a lot of money. You worked the 40-40 life. At 30 years old, I successfully turned $7,000 into $200,000 in the stock market, only to lose it 80% of that. So I am that old. I'm probably older than all of you here. And then I go into a bookstore. I find that purple book that sent me on an entirely new journey. So I started buying rental properties in the Central Valley of California in 2001. Just by sheer grit and work and focus over time, built that up to a more substantial portfolio. And then I quit my job at a moment's notice at 45. I thought I'd work till 50. I didn't. A bad day happened and I quit. And since 2018, I've been trying to help full-time employees understand that their job's a key to the financial future and not a prison. I think too many people think their job's a prison, where if they just change their orientation, they could see some good things. So yeah, wrote a book, got a YouTube channel, all that stuff. But yeah, it's more about, for me, it's really about growing the middle class, trying to show them how, just a couple of money moves could really set them on a different trajectory. So that's what I'm trying to do.
And when you say the purple book, just to be clear, we're talking about Barney the dinosaur?
Yeah, Barney the dinosaur. Yeah, my daughter's favorite book. But no, it would be Rich Dad, Poor Dad, of course. My bad.
Everybody love everybody. Well, we thank you for joining us. Did you you a drinker? You bring something to drink for us?
It's a little early for me in California, so I'm not drinking. I will have a drink tonight with you guys when we go out with my wife for dinner. But since I'll be driving, I'll wait.
Well, calling you out, Mauricio, because I believe you guys aren't that far from each other out in California, and you definitely have a drink. What do you got going?
Orange County, so can't be that far away.
Well, Orange County, I don't know. Is that really California?
No, that's true. Are you north of Santa Barbara or south of Santa Barbara?
North, so I'm in the Silicon Valley. Right
yeah,
near
that's
Google,
not. Yeah. It's just so that people who are listening who are not from California, anything that's north of Santa Barbara is not really California. I'm not quite sure what it is, but anything south of Santa Barbara, that's the true California. In case you guys were wondering.
Well, in Mauricio's county, they're just drinking and drunk all the time. So
that's how you stay. You cure hangovers. Just stay drunk. I got it.
Yeah, you don't detox. You just retox.
Yeah. I get it. I get it.
So what do you got first, Mauricio? You got some more ginger piss,
Dude,
or
what do you got? You know what? I'm kind of done with this. I tried. Look, I'm halfway through this bottle, but this Pisco from Peru is just not cutting it. Like the pisco from Peru is just, this is the last one. I apologize. I'm gonna have to go back and get some real pisco from Chile and maybe enjoy a little pisco next week. But for now, I'm just drinking a little piscola, but really not up to par.
Jay, how's it going there, man?
Going well. I'm going to be leaving this podcast in a couple hours and probably going to put up my hurricane shutters because it looks like we may be getting a hurricane here.
Are you actually going to do it this time though? Like we literally had to beg you to put up your hurricane shutters last time. You're like,
we'll do what we did last time. We'll wait till the last minute, make sure it doesn't actually change path, and once it starts to drizzle, then we'll rush to get the hurricane shutters up.
what do you? I assume you're well stocked for alcohol then. If you're hunkering down for the
which
hurricane.
Costco wine are you drinking this week?
We've still got a half case of the circumference from Costco, so that's what I'll be drinking again.
Why don't you drink the circumference like on your own time, and you can mix it up a little bit for the podcast?
I told you I'm down to a half case, so yeah, I've been drinking it on and off. I saved the good stuff for other people.
Oh, okay, I get it. Well, if you haven't heard that we're heading to Cancun for Bigger Pockets in 2 weeks, so I'm thinking I could lose like 5 or 6 pounds in 2 weeks. I'm hoping like that's normal, right? So I was like, okay, I got to slim down. What's some alcohol that I can use to slim down?
Geez, no,
don't
do it, Kyle. Don't do it, Kyle.
I heard that light liquor is a little bit lower calorie than dark liquor. And so I went up to my bar and I had to look all past all the bourbons that I had. And I saw this bottle and it's called it starts with a K. It's clear rum. I've heard of them in these ready to drink cans, but this, just the pure rum. And I tried some, but it's really smooth. It says no carbs, no sugar.
No taste,
really
no nothing.
Yeah, it's great. All right, let's get into this. Regardless of us having a nice guest host, Jay would get grumpy if I didn't put him first. And so it's either between Mauricio being grumpy and Jay. I got to deal with Jay a lot more. So I'm going to let Jay go first. And the news of the week last week was obviously the Fed coming in over the top and handing us not just a rate cut, but a 0.5 point rate cut. Woohoo. Even though this was the betting market favorite, it definitely surprised me. I'm not going to lie. I thought they were just doing a 0.25 point. So the question is, Jay, did they make the right call here?
So let me start by throwing this back on you guys. So let's take a quick poll. Who thinks 50 basis points or 0.5 point rate cut was the right number, or was it too much or too little? What do you guys think?
Actually, I have a little twist for you. So I've been calling rate cutting cycle on my channel for 4 or 5 years and been fairly confident. This was the first one that I had no idea. But going into it, this is what I said, and I'd love your feedback. I said, if they go a quarter, the Fed is concerned about the economy. I said, if they go a half, they're afraid. And obviously they went a half. I think the Fed's afraid. And now the answer is, what are they afraid of?
Well, that's why I thought they were going to do a quarter, because I thought that by doing 50, they were admitting that they waited too long. And that's why I think they made the right move in doing 50, because I do think they waited too long, and this was them trying to correct for it. But I didn't think they were going to just straight out admit that. And Powell tried to do his speech, and he tried to downplay it that, it's just 50. We're just showing our commitment to keeping everything the way it is. But at the same time, I think you're right. Like it was not panic, but it was kind of them saying, "Ooh, geez, like we maybe should have done this a little earlier."
So you think it's a July makeup?
That's what I pegged. I think they should have cut in July. Let's be honest. I thought they should have slowly been cutting all year. But for sure, July. And I think this was just them saying, "Oh, we should have done that."
Mauricio?
Yeah, I look at I don't know what, I just see this as a I don't say a panic move, but I definitely think this is there's something going on there. I was looking at the graph. I'm trying to pull it up for you guys, but I don't have enough time. But I mean, if you look at all the times in the past, especially in the last 30 years or something, that the Fed has dropped rates by 50 basis point in one, to begin the cutting cycle, it's never good news. It's always because they're a little bit behind the curve. They start cutting by 50. And this idea that they're going to cut, 50 this time, 25, like a nice and smooth. I mean, forget it. I mean, it's always 50. Maybe the next one will be 25, but this thing will be cutting so fast because the recession's coming. And again, not that history repeats itself, but it certainly rhymes. I think that there's something, we've been talking about this for a while now. There's something brewing. Unemployment's obviously going higher than I think they want. That's probably the main reason now they're concerned
Well,
about.
it could have just been that we had an 800,000 job revision.
Right. I think that's part of it. Yeah.
Okay, so here's my take.
No, we don't care about your take anymore. You handed over the mic and you lost the mic. You've lost it. So,
So I agree the Fed was behind the curve. Same as Kyle. I think Kyle and I were both saying like back in April, May, July, we should have seen cuts. I was actually really surprised we didn't see a cut in July. So we were pretty certain the day after the July non-cut that there was going to be one this month or last week. But we weren't sure. We assumed it was going to be 25 basis points. And it was only like the last week or two that the market started predicting something bigger than 0.25%, predicting
which was funny because it wasn't like usually when you see these massive moves, it's on the back of some like announcement or some press release or something. It wasn't any of that, which makes me think like we all know that the Fed has their like little insider news people, and it makes me think that they were like, okay, we want to cut 50 and no one's getting that message, so they like planted some news stories and did a few things to try and move the markets a little bit.
Yeah, I was going to say, I mean, if you look at the markets, I believe the betting markets had it down as low as 9% heading into that final weekend. I think it was Thursday or Friday. And then, the guy we call Nicky Leaks from the Wall Street Journal put out an op-ed, I think it was Saturday morning, that took the chances of 50 back up to 46 or 47%. So you're right. I mean, going into this cycle, the market was not positioned for a 50, and the Fed was like, we can't shock the market this bad. We've got to whisper some stuff.
Well, for all the people out there who, like Kyle, think that the Fed is getting data that nobody else has, and they're ahead of the news cycle. I mean, I know you think that, but let's be realistic. What happened?
I've never said that.
You just did. You just said they're getting information.
No, I said that they're leaking information to news people in order to sway the market.
Fair enough. I thought you were saying they were getting information ahead of us, and so
no.
Okay, so a lot of people believe that, and I think the fact that
I think it's pretty evident that they're not. Like they're like
they might get it a day ahead of time, but not
exactly.
Not
much.
Like not even a day ahead of time, because if you remember in July they didn't cut, and then the day after we got some really bad news on jobs, and so I think that was telling. But let me say why I think the 50 basis points cut was the right cut, and also why I don't think it's it's not necessarily a big deal. It's not necessarily indicative that something majorly bad is coming down the road, and that's because we've talked about this term before called the neutral rate. And for those that aren't familiar, the neutral rate is this let's think of it as this optimal rate. The optimal rate for the federal funds, where the economy doesn't speed up. It's not so low that the economy doesn't speed up and overheat, but it's also not so high that the economy doesn't slow down into a recession. It's this optimal rate where everything's kind of in stasis and perfectly balanced. And these days, it's very, very clear that 5.25 rate where the Fed was last week was well above the neutral rate. Most people think the neutral rate's probably somewhere in the 3 or 3.25% rate. So we'd have to get down to 3 or 3.25% for the rate to be where we're not going to see inflation and we're also not going to see jobs loss. And so when you're 2 points above that neutral rate, you run the risk of things slowing down too quickly. And I think what the Fed was concerned about was this was the last chance to cut rates until November 7th, which is 2 months from now. Normally we have these meetings every month, or most months we have these meetings, but we don't have another meeting for 2 months. And so the Fed doesn't have an opportunity to kind of switch course or change paths between now and the election if something bad were to happen. And so I think this was just an opportunity to make a big jump towards that neutral rate without taking too much risk, because we're still 1.5 points at least above that neutral rate. And now we're set for the next 2 months, and the Fed can make an informed decision come November 7th, which again is 2 days after the election. They do one cut before the election, a little bit bigger than expected. And now hopefully everything is probably in pretty good shape for the next 2 months. And so
is anyone else kind of excited for like the timing on that? Like, what are they going to say? Like, it's like the election will have just happened. Like, it'll still be like full election results. And like, if it's super close, like we might not have even found out till 12 hours before. And like, I'm kind of excited to like, what kind of meeting is that going to be like?
But imagine if it was the other way around. Imagine if the Fed were to have this next meeting like 2 days before the election. Like no matter what they decided to do, half the country would be up in arms saying this was political. They're trying to impact. Like they don't cut. Well, obviously they're in the bag for the Republicans. They do cut. Obviously they're in the bag for the Democrats. So I think they're actually pretty lucky that it's 2 days after the election and not 2 days before. And maybe that was part of the calculus when they set the meeting dates. I don't know how those meeting dates are set, but I have to think. And so maybe that's also the reason why there's no October meeting. So I guess it was probably by design. So long story short, I thought the 50 basis point cut was reasonable. I think we're going to probably see some more cuts after this. Interesting data point, though. Normally, all the Fed, so I think there are 12 voting members of the Fed committee that vote on rate cuts and how big of a cut. And going all the way back to 2005, there's never been a member, or since 2005, there hasn't been a member of the committee who has dissented, who said, I disagree with the other 11 members. This was the first time since 2005. One of the committee members basically said, I think 0.5% is too high. We should be doing 0.25%. And specifically, she said that she thought that the risk to inflation kind of reemerging was too high for doing a half point cut, and she would have done a quarter point cut. So it is interesting that normally those 12 members are in lockstep, but this time around there was one dissenting member.
Yeah, Michelle Bowman deserves a lot of credit for standing up and saying, I thought it was a quarter. The other thing, if you really listen to Michelle Bowman, because she spoke her piece this morning at whatever she was at, some presentation, and she basically highlighted the inflation, but she also highlighted money flying off the sidelines. She talked about $6.4 trillion in the money market account, and she was afraid that we could essentially have a melt up or a crash up in asset values, right? Because a lot of people want to talk about inflation, that's consumer inflation, but there's also this thing called asset inflation, and you could have one without the other. And, Michelle Bowman was basically saying, I don't want to send a signal to Wall Street. Wall Street's going to, they got a foot, they're going to take a mile. And I think that means we're going to get another 50 in November. I'm saying it right now. I think we get another 50 in November. I also think Michelle Bowman said she thinks R star or the neutral rate is higher than her peers. So she's probably more at 4, where I do think the other, members are more like 3.5. But yeah, I think another half is coming.
What's interesting to me, though, is like I'm going to throw it back to you guys, but everyone seems, bring it back to real estate. Everybody seems to be celebrating that, hey, we have a 50-point basis cut. That means mortgage rate's going to go down, which means it's going to be easier for people to get houses and blah, blah, blah. And I'm like, is that really good news? I mean,
rates went up. I get there's a supply and demand factor going on with treasuries and stuff, but fundamentally, when I don't want to call it a toss up, but it was pretty close to a toss up, whether it was going to be 25 bips or 50. And the fact that they picked 50, you would think that would imply that rates are going to go down at a faster rate than if they pick 25, and therefore the treasuries should go down. But like right on the announcement, they did go down. So I'm like, oh, here we go. Like it went like from 3.7 down to 3.65 for the 10-year treasury. But then literally within like an hour and a half, all of a sudden it was up at like 3.77. And then it had held up there. That was the most shocking thing to me, is that like, oh, we get the 50 bips. That, to Mauricio's point, like everyone's like, oh yes, finally they're actually doing 50. They got their finger on the pulse. We're going in the right direction, and the 10-year treasury goes up on us.
Yeah, but I mean, again, I want to just kind of look. I want to share the screen here. I want to, for those of you who are not watching, is that here's the Fed funds cut for the last whatever it is, 30 years now, and as you can tell, if you even go back to 1988, 1889, when you see these first initial ending of the hiking rates and they pivot and start coming back down, it usually precipitates pretty fast. Like if they start with a 50-point basis cut, they're usually going down pretty fast, and it's usually then the recession's coming pretty fast. It's like, look at even, obviously we remember 2001, 2008. I mean, did you want to go buy real estate in 2001, 2002, when we entered the recession and interest rates were getting cut from whatever they were, 6.25 down all the way down to 1? Is that an environment that was really appealing to real estate investors? I mean, the only time on this graph that they started to cut that went a little bit kind of according to plan, which I think is what the Fed's looking for now, was in this like 1994, 1995 part, which really kind of went slowly down. But the difference between all these other times where it's peaked and gone down pretty fast and there's been big time cuts is, number one, we've talked about the inverted yield curve. Like this is the every time the yield curve's inverted and you have this unemployment spiking, and we talk about the Slum rule all the time, but when unemployment starts going up pretty fast, in this particular, I mean, if this follows history, you're looking at a recession, and the question is that really good for real estate investors right now? Yes, if you wait 12 to 18 to 24 months, if real estate starts to correct a little bit and it becomes harder. But this idea that because interest rates are starting to cut, that's somehow good for the market. It's like if interest rates are going up, it's like, oh, it's a great time to buy because, at some point they'll turn around and prices are coming down. And now that they're suddenly starting to cut, everyone seems to be automatically thinking this is great for the economy, this is great for real estate, this is great for anything. And I'm kind of thinking it's the opposite. It's like, if we enter in a recession, which we've all been thinking it's coming, not thinking just out of our hats. I mean, we're looking at all the data. The question really is just, I guess, how severe this recession is going to be. But if we enter a severe recession, and to Michael's point, if we're continuing to cut, yeah, we might cut another 50, but we might have to have a 100 basis point cut in November.
Yeah, but what if it's just a little mini recession, just a little guy, like a little?
Let me throw something out with you guys. I don't know if you know this, but I actually have an econ degree, MBA, been studying the economy and consumers for 30 years, kind of my wheelhouse.
We never would have invited you on the podcast if we knew that.
Yeah, my bad. Sorry, I'm here already. But I think what we're actually experiencing is a textbook rolling recession. And a rolling recession is very, very different than what we experienced in COVID, in the great financial crisis and the dot-com crisis. Those were kind of all over the cliff, kind of Wile E. Coyote over the cliff and then falls down, everything together. What if we've already been in a recession for the last 12 to 18 months? A rolling recession might take 2 years, might take 2.5 years. A rolling recession doesn't have to be negative growth, just below trend. Really what a rolling recession is different parts of the economy are in a depression, AKA housing, AKA mortgage, AKA real estate. And then that part of this stuff comes out and other parts in. Maybe it's discretionary, maybe it's travel, maybe it's whatever. But I think we all have so much recency bias. We all remember the V-shaped recovery. We all wish we bought the stocks at the bottom. We all remember the great financial crisis where housing crashed. But when you study the economy and you realize the M2 money supply, $9 trillion or whatever the heck the number is, was pumped into the economy, I think we have to zoom out and realize there is so much liquidity still out there that is just trying to find its home. And now, because rates are coming down, I think we all believe that, I think we're going to see 6.4 trillion or some portion of that fly off the sidelines into assets. So, and then back to your earlier question, Mauricio, I was buying in 2001. My market went up 150% from 2001 to 2005. So yeah, I thought it was a pretty good time to buy single family homes in 2001.
I was going to bring that before you. I think we need to distinguish between, for real estate, single family and commercial, because other than 2008 recession, and I think Jay's brought this up multiple times and he's shown graphs and stuff, and so I'm kind of stealing from him, like single family real estate didn't do that poorly in previous recessions. It was only 2008, and to your point, Zoobs, it's like recency bias, where like the last recession, the last big one, we don't really count COVID, but like the last big recession, like single family real estate like tanked. So if you look at previous recessions, though, it wasn't that bad. Now, commercial real estate, which is a little bit more susceptible to interest rates, to bank liquidity, to things like that, then they might fare a little bit worse.
Yeah, and I agree with the rolling recession, but I would add an extra axis of analysis in there. And this is what we talked about. It was a week or two ago that we're seeing kind of a tale of two cities here. With inflation, we saw like just the middle class get decimated. And over the last 4 years, we've seen $5.5 trillion move out of the middle class from the 50th percentile of wealth holders through the 99th ninth percentile of wealth holders. Half of that's gone to the bottom, which is good because those are the people that need to be able to buy their commodities. They need to be able to buy their clothes and their food and their gas. The other half has gone, $2.5 trillion has gone to the upper 1%, and that's gone into hard assets, and that's why we've seen the stock market go up and real estate go up. And so, yeah, there is a rolling
You're saying
recession.
the billionaires aren't putting all their money into crypto, Jay? Is that what you're trying to say?
Well, we've seen crypto go up also. We've seen gold go up. We've seen everything go up.
Is this your shit sandwich analogy that you
This
brought
is
up
my
last
shit
week?
sandwich. Everybody's doing really well at the top.
I have a question for Michael. I do have a question for Michael. I'd love to get his opinion on this because you mentioned the trillions of dollars on the sideline that are going to be pumping in. And I want to get this on tape or on video because I want to replay.
I was just showing your age there. Eh? Get this on tape.
Look at the I want this on tape. But like, actually, Jay and I have a bet on this. I don't know. I'm not quite sure what the terms of the bet are, but I believe that before the end of this decade, so I mean, we're already almost halfway through the decade, but we are going to be having discussions as to whether we're going to be taking out that 9% inflation number from 3 years ago or 2 years ago. Do you agree? Do you agree with that statement that by the end of the decade, inflation will start popping up again and start to test the highs of however long ago that was? Or do you think now, do you think we'll test that again? Will we get up to 7, 8 and we'll be having a discussion whether we take that out? Or do you think, nope, inflation
Mauricio's already hedging here. He used to say go above 9%. So now he's like, oh, we're going to test it.
Let's go above. I want to have that discussion. So the question is, do you feel, or do you think it's already been tamed and this was like a transitory and we're back down to 2 and we'll be back down to 2 for the foreseeable few decades here?
Yeah, so kind of I'll give you both. I'll give you my complete thoughts on this. I have studied the early 80s a lot, right? I was born in 72. I remember being a young kid in 91 or 81 when my dad lost his job for 12 months. And 81 sucked. 82 sucked in America. It was horrible. And a lot of that was because of inflation, oil embargo, the job market. It was just nasty, right? And not a lot of people like remember it, could feel it. And I can still. The gas lines and all of that. So the answer is I certainly hope not. It would not be something I would wish on the population. Although I think an aggressive rate cutting cycle like I see ahead of us, we have all of these horrible wars going on around the world. We have growing power in India, a shrinking power in China. This is a powder keg, and it's not impossible for me to see a repeat of kind of the Arthur Burns to, God, I blanked on his name for whatever, Paul Volcker. Wow. How did I do that? Arthur Burns to Paul Volcker. It's certainly possible, but it's not my base case. I would put it as a tail risk, less than 10%, probably less than 5%. I think if you really step back and have an honest discussion about why we are having deflation in many segments of the economy, if we have an honest discussion about where inflation still is, it's in the services and things like insurance and things of that. It really does paint a picture that it was transitory. It was just longer, transitory, needed years to play out. It was very much supply chain. That said, we bring big manufacturing back. We bring 200% tariffs from China goods. There are some decisions we could make that would force inflation to go higher, right? If you suddenly made it cheaper to manufacture goods in the US than China, you bet your ass we're going to have 10% inflation, right? There could be some choices. I don't think we're that foolish. I certainly hope we're not. So that's my thoughts.
Don't fearmonger here, Zoobs. If there's a Trump tariff, then China's paying the tariff. It's not the American people who are paying those tariffs. So I don't want to have this like fake news coming on my podcast about the fact that tariffs are going to lead to inflation. Okay.
I'm just glad to have somebody here who finally agrees with me on this whole inflation thing. So
hey, I've agreed with you the whole time, Jay.
I just can't wait to go back. Maybe in 3 years. I don't know if this podcast will still be around in 3 years, especially if Kyle's still hosting it. But like if it's still around, like I want to be able to play back that clip that I just said. And
I know you're the same one as that one dissenting vote on the from the FOMC where it's like, oh, we got to have one person who disagreed just in case they're right. So then they could be like, I was right back here, play back the clip.
You know what, Mauricio, I think there's a better question you should ask, because I really do think, and most people don't know this, there's two types of inflation. I think consumer inflation, I don't think we revisit 9.1. In fact, I don't think we revisit 5, to just put some context on this. We could get to, back to 3 or 3.5, but not 5. However, what about asset inflation, right? There's all these reports about single family homes being down 1 million to 1.5 million. We have all these immigrants coming into the country that need to be housed somewhere. What about asset inflation? What about the stock market going up another 10%? What about the US dollar depreciating another 10%? I mean, those are some real concerns, because back to Jay's point, if we're seeing the shit sandwich of the poor growing and the rich growing, and there's nobody in the middle, that's not the United States that I remember, I hope for, man. I want to see the middle class grow, not shrink.
Well, I don't know if you were just teeing Jay up here, but Jay, I think, has some data on stock markets, on gold, maybe even Case-Shiller. Jay, you want to hit us with some of that?
Yeah, but before, I want to talk about one more thing, because I'm getting this question a lot, and that's, so we had a 0.5 rate cut, but where are things headed from here? And so real quick,
Mauricio, geez, we had this whole conversation before that I'm supposed to step in and moderate more because we get long-winded on these things. Like, this was spearheaded by Jay, that we want to keep shorter segments, and I literally moved it along, pushed it onto the next segment, and Jay's like, no, I want to bring this right back. So if you were trying to say that we need shorter segments, Jay, this is your fault right now.
And I love how Jay also really is trying to say, hey, we need Kyle, give power back to Kyle so he can moderate a little bit better. And then Kyle does his best to moderate, and Jay just steamrolls the poor guy and wants to keep talking about whatever.
So let's talk about where rates are headed. So 2 ways to look at this: where the market thinks rates are headed and where the Fed thinks rates are headed. Real quick, this is where the market thinks rates are headed. As of today, the market is predicting over 58% chance that we're going to see another 0.5 point cut in 2 months.
Totally agree.
Yeah, I think this, I mean, there's a lot of data that's going to come out between now and 2 months from now. So who knows how this could change? It could be larger, it could be a smaller cut, but I think this is a reasonable base case right now that we're going to see another 0.5 point cut. 41% chance that it's only going to be a 1/4 point cut. Go out to the end of the year, and we're looking like there's a reasonable chance, the market thinks there's a reasonable chance, that we're going to be down all the way somewhere between 375 and 425, like over 80% chance.
So to put that in plain English, the market is betting on 75 more basis point cuts with a 33% chance of 100. That's what the market is saying.
Exactly. And to get that, we only have 2 more meetings before the end of the year. So that means one or both of those meetings would have to be 50 basis points, and both of those meetings we'd have to see a cut.
Mm-hmm. Correct. So what do you think? Do you think we get 100 by the end of the year?
I don't think so. I think unless we get some bad
Well,
news.
Jay, before I decide, I want to see the Fed dot plot. What did you planned on throwing that up? Put that up, and so we could see what the Fed thinks it's going to be, so we can do the exact opposite, because they're never right.
So this is what the Fed thinks. So every quarter, the Fed comes out with this thing called the dot plot, where each of the 19 members of the FOMC committee basically says, here's my best guess on where rates are going to be at the end of this year, next year, the following year, and so forth. Keep in mind, this isn't them making any, they're not actually voting on this. This is just their guesses, but ultimately they will vote. And what we see here is that basically the consensus is that we're somewhere around 425, maybe even a little bit higher. So they don't think, as of last week, they didn't think that we were going to see that big of a cut before the end of the year. The market's predicting an extra 1/4, 1/2, even 3/4 point cut over where the Fed thinks we're going to be by the end of the year. By next year, by the end of 2025, the consensus of the Fed members is somewhere around 3.25. And then longer term, meaning 2027 and beyond, it's a really narrow curve, meaning that none of the Fed members could agree. And I mean, they're between 2 and 2.25 and 3.75. So by longer term, it seems like none of the Fed members can agree on whether things are going back up or going back down. And so it gets interesting over the next couple of years.
I will make one observation, though, that the Fed has a relatively new playbook that they've been using basically since the great financial crisis. And I have no doubt that they will pull out that playbook, which is if we do end up having a recession, if something starts happening that they don't like, I don't have any doubt that they'll go down all the way to zero again. Where I think if you look back into the 1990s and 2000s, that wouldn't have been considered by Greenspan or any of those guys, certainly not Volcker. But I think now if things get bad enough with all the debt that we have and everything, I just that's in the playbook. That wasn't in the cards 20 years ago, or maybe now, 20 years ago, 20, 30 years ago. But I think that's in the cards. So if you suddenly have a hard landing, like a steep recession, stock market starting to tumble, confidence going down, unemployment's going up, things are not going well.
Government debt keeps getting bigger and bigger and more expensive. So,
Kyle, I'm going to give you permission to move on.
Well, so I had a great pivot there, but like now I don't even know how to. I got to like hard pivot.
Well,
to
let me answer the question you asked before. So you asked about any other data that we had.
You want to talk about Case-Shiller, Jay?
Yeah, we have one more piece of data that's come out just this morning. Housing prices. So where are housing prices going? Well, Case-Shiller came out with July data. They're about 2 months behind. But as of July, basically what we saw was housing prices are still going up. Now, they're slowing considerably. The rate of increase is slowing. But we saw another all-time high in housing prices in July. And is that trend going to reverse come the August numbers next month? I don't know. But as of now, housing prices are still going up.
Michael, I need to go buy a house pretty soon here. Is this a good time for me to buy?
Well, it depends on your timing, right? So if you're really serious right now, we have a buyer's market. I mean, if you really want to talk about this, I've been doing real estate, specifically single family homes for, almost 30 years. And I think starting about a month ago, probably through January 15th, we're in a buyer's market. They are very short lived. A buyer's market means it's easier. It's never easy, but it's easier to find motivated sellers. I think in order to get a great deal today, you have to find a motivated seller. You have to write disrespectful offers. You have to follow up. You have to really grind and get the best price. You have to ask for seller credits. You got to ask for points. Some people have to sell, right? They need to sell. Some people want to sell. Going into this cycle, we have a lot of people who want to sell, right? They want last year's price. They don't have to move, right? They got 2% interest. They're stuck. They're not going anywhere. But death, divorce, job transfer, probate, undefeated. Some people have to sell. And if you're willing to do the work, write lots of offers, hunt for that great deal, certainly possible. If you want to step back and be an owner occupant, which is, do a house hack on a home with roommates or do a fourplex or get a 2 or 3K loan and take on a fixer project. Owning single family homes is the way most people in the middle class own assets. And if we learned anything from the shit sandwich that Jay was talking about earlier, you have to own assets, whether that is real estate or stocks or something. And, I love just boring one rental at a time, single family homes. It works. It's hard. I mean, today's affordability is atrocious. It's not the worst ever, but it's the worst in the last 30 years. So I'm not saying it's easy. I'm just saying it's easier now. But going into the future, I don't see home prices going up. I think we saw a lot of appreciation in the first 3 years. I think we're going to be flat for the next 2 or 3 years. We had a crash, but it was in transactions, not price, which just drives people bananas. We told them that was coming, but they didn't want to believe me. It's tough out there, but I bought a home last year. I got $100,000 off. I got the seller to buy down my rate to 4.9. And got 10K in closing costs. So it's
So you think the prices are going to be below the rate of inflation?
Ooh, nominal versus real. There's a good question.
Yeah.
Any 1 year, it's hard to say. But I think over time, I've gone back to 1970 and studied it. Real estate is only 1% above inflation. When you look at it historically, I think next year it's probably even. I mean, if you wanted to adjust for inflation, I'm calling plus or minus 1%. It's going to be a nothing burger. It's just unaffordable.
I'm just talking like for the rest of the day. Kyle, you can retreat. I don't think we need you anymore. I got this covered now. Do you think
I literally, you never go in the document, but I have a whole intro written to lead into the next segment.
Okay, well, let's pretend Mauricio didn't jump in.
By the way, I got so excited I just spilled all my water. So if I'm a little fidgety, I'm just trying to clean up over here.
Your intro to the next segment was, "Hey Zuber, I'm looking to buy a house. Is now a good time?" Like that was your intro.
I thought
into
that was the
next
best
segment.
transition. I was waiting for your transition. You took too long. You let Jay steamroll you. I just got in there.
We're talking about rentals. Like we don't care about your, California single family housing market right now. We're talking to real estate investors who are buying single family rentals. And so I had a whole intro to set them up about is now a good time for single family rentals. And
yeah, but
you
rentals are based on comps, and single family rentals are based on
yeah,
comps.
but there's
and so-
more factors that go into that. What rather than just our price is going to go up higher than inflation. No, like you have to. There's actual rent.
I don't get a chance to talk to Zuber that often, so this is where I get my chance to ask him all these
Well,
questions.
just let me do the intro next time. He could do his thing, and then you could talk all you want.
Let's start it over. Kyle, go for it.
No, the time's over. We're talking about now. We're talking about single family rentals, SFRs.
He's taking his ball and he's going home.
I'm going home. I'm taking the ball.
Let's talk about single family rentals because I think my rant there was very much owner occupant, which I apologize for.
No, I thought it was great. I thought it was great.
So, but buying rental properties, that's hard. But I think there are some things that the average investor needs to appreciate. I think most real estate investors, most wannabe real estate investors, they get excited about real estate because they see the wealth or the income that you can generate here. And it is ungodly if you do it right. However, as all of us know, there are dozens and dozens of ways to do it, dozens and dozens of ways that may or may not work based on the environment we are in today. For example, Burr might have been the best strategy from 2017 to 2022 ever. I would argue today, not nearly as easy. Possible, but not nearly as easy. Buying rentals is particularly hard today. We've seen a lot of appreciation in prices. We've seen high rates. Again, remember that investor loans are above owner-occupant loans by 3/4 to a point, depending on the lender. So that makes the cost of capital even higher. But that said, I think most new investors just need to focus. I think most new investors need to get what I call a buy box. Right? They need to take their zip code or their city of Orange County or their city of Fresno or their city of Sarasota or Philly or whatever it is. And they need to get really, really micro. And then they need to look at that little micro every day. Because I think what happens when you do something like that is you can start to learn the rhythm of the market. You can start to identify what a great deal is. To me, real estate investing is a skill. It'd be interesting to see if you guys agree. I think real estate investing is like playing golf or learning a foreign language or playing an instrument. You only get better the more you practice, and you only get better practicing every day. I think too many people are focused on it's a bad time. That's kind of the wrong question. Now's the time to learn. Now's the time to figure out what an average deal is in your buy box. And an average deal in your buy box might be negative, which means don't buy it, right? Don't buy bad deals. Don't buy alligators. But you've got to get in the market. You've got to learn, because something I've learned about real estate over 25 years is it always changes. It always changes. So
let me drill in on that a little bit, because a lot of people buy, you say buy for cash flow, right? And you have all these rules of thumb. And one of the rules of thumb that I've heard a lot with single family, and back when we did single family, is like you want to cash flow like $300 a door. Let's get the $300 a door cash flow. Well, that was back when rates were significantly lower. So is it still one of those things though, where you can, I think it's like the real estate guys that say, marry the market, date the rate or something, like it's something around there. Where is it one of those things where you could say like, okay, instead of like targeting, like I needed $300 cash flow before, with the rates that are currently here, as long as I'm positive cash flow, I know the rates are going to come down at some point. Like, is that still an okay deal to be getting into, or are you avoiding that still?
I kind of avoid that mindset. Also, the 1% rule I think is atrocious. I think it attracts or focuses you on the wrong parts of lots of markets. What I look at, guys, is I turn every single family rental into a bond. So what does that mean? Down payment, closing cost, make ready is the denominator, and the numerator is expected cash flow over the year. And that just becomes a percentage. And what I want everybody to do by looking at their buy box and tracking it is, hey, an average deal in my market is 1.5%. Well, hey, if it's 1.5%, stick your money in a money market account and go earn 3 or 4%, right? I'll give you an example of my buy box from 2001. 93703, single family homes, 3 or 4 bedrooms, 2 baths, 2-car garage, single story, 1,250 to 2,100 square feet. Why was that? Because that very focused criteria gave me an active inventory, right? Realtor.com, Zillow, whatever it is, of about 25 active listings. I did not live in Fresno. I never lived in Fresno. I didn't know a soul in Fresno, but I knew the math. So I looked at that very set of criteria I just ran for 3 freaking years. After 6 months, back in 2001, I knew an average deal was 6.5. I don't want to do average. I only have to do 1 deal a year. So I want to learn average and then do great. A great deal is 2%, 3% higher. So many people want to jump the line to writing offers. That's just gambling, people. And, you shouldn't do that. So I believe you should do yield, right? How hard is my money working?
So I'm gonna be the bad guy here for a second. Uh, yeah, it's always a good time to buy real estate, but let's be realistic. This is the worst time to buy single family houses in a really long time. There's 4 ways you make money buying real estate, and especially single family rentals. Number 1, you get the cash flow. Number 2, hopefully you get some appreciation. Number 3, your tenants are paying down your mortgage, so you're getting what's called amortization or loan pay down. And number 4, you're getting tax benefits. 5 years ago, you were getting all 4 of those in spades. You're getting tons of cash flow because interest rates were low. You're getting tons of appreciation because housing prices were spiking. You're getting tons of tax benefits because there was 100% bonus depreciation. You're getting tons of principal pay down because mortgage rates were low. So every payment was like mostly going to principal. And so you were getting all those things. Go back 10 years and you might not have been getting the appreciation, but you're still getting cash flow and tax benefits and principal pay down. You go back 20 years and yeah, you might not have been getting as much cash flow when interest rates were higher, as much principal pay down, but you were still getting really good tax benefits. You were getting really good appreciation. These days, what you're getting is a little bit of cash flow if you're lucky. I think over the next several years, we're not going to see a ton of appreciation. I mean, real estate is so far above the trend line, that trend line being inflation that we talked about earlier, that it either has to come crashing back down or it has to stay where it is while inflation catches up over the next 7 years. And so I think we're going to see very little appreciation over the next few years. Principal pay down, well, if you buy a deal today, yeah, you're going to pay high rates, and the first couple of years, you're going to see very little principal pay down. It's mostly going to be interest. And then tax benefits, well, even if you're doing bonus depreciation, cost segregation, we're seeing that starting to phase out. So yeah, you're going to get each of those to some degree, but a whole lot less than we were seeing just a few years ago, or 10 years ago, or 20 years ago, or 30 years ago. And I will be the bad guy and say, while it's always a good time to buy real estate, because in any 10-year period in history, real estate has only gone up in value. While that's true, now may be the worst time in decades to be buying real estate. Don't stop buying, but don't think you're going to retire tomorrow. Don't think that you're going to get wealthy in 5 years. Buying real estate today is a 10, 15, 20-year play.
Well, I think getting wealthy is always a 10-year play. So we agree on that. I also agree that affordability is unquestionably atrocious today. It's the worst since 1982. So what's that, 42 years? But that said, as kind of I said earlier, there's always a way to do it. There's some strategies that work better or not in the era we are in. I think the era, and again, if I was coaching, Mike Zuber at 20, I would be telling myself to house hack. Why would I do that? Well, other than taxes, the most expensive thing we have for most of us is shelter. So if we can set up our lifestyle where half or most of our shelter costs are covered by my tenants, either roommates or in units, that just turbocharges my ability to save discretionary income. Because let's be very clear, getting rich is a simple formula. Create discretionary income, become an elite investor at something, and do it for a decade. So house hacking is one of the best strategies today because of high prices, high rates, all of those things. The other thing is it's it is always possible to find deals. It's hard, right? Seller financing, creative financing, all of those. But yeah, I'm not trying to tell you that 2024 is like 2010. Come on, I bought like 30 properties in 2010. Very different market. But, most of us only need one. And most of us don't want to, it's not the easy button. Real estate investing is never easy. Do you guys remember the time where you could only get 4 loans? I do, right? Do you guys remember a time where, rates were over 10%? I do, right? It's real estate's always hard. It's never easy.
Yeah, I want to make 2 quick points. The first one is I love Michael. I love the mindset of that you just talked about in terms of just going into a marketplace, whatever that is. It probably start with that, right? Like, what markets do you like, and maybe pick 2 or 3 markets or whatever, compare them. But once you settle on a market or two, to just be an expert in that market and know exactly what the market is and just master it. So now you know what an average deal looks like. And so when you look at a deal, you'll know whether it's above average, below average, what it should be doing. All that. I love that philosophy anyway. What I'm a little bit surprised from both of you is the idea, because it kind of goes against what I'm hearing a lot of folks in the single family space say, is like that you're going to have little appreciation, because all I'm hearing about is rates are coming down, which means prices are going to go up. And I always hear supply, there's no supply, we're not building anything, and everybody's got a 2% mortgage, so nobody wants to sell.
There's all these millennials sitting on the sideline just waiting.
Why can you, maybe both of you, if you want to dive in a little bit about why you think the single family home isn't going to skyrocket? Interest rates are going to be 2% lower here in the next 12 to 18 months. Like, why isn't real estate?
Well, let's talk about that, because I think that's the incorrect assumption. I do not see mortgage rates 2% lower than they are today. Right. I think that you got to remember there's this long end and the short end. The Fed controls the ultra short end out to about the 2-year, and the market, controls 5-year, 10-year, 20, 30-year. I think what we're going to see very quickly is a steepening, and it's already starting to occur where the long end is up and the short end is down. So I don't see mortgage rates with a 4 on it. I'm not even sure I see mortgage rates below 5.5 in 24, right? And that's with 200 basis points of cuts.
But I always hear Jay. Wait. Jay's the economic expert. He's the number one economist in the country. And he always talks about how there's always a spread between the Fed funds rate. Like, teach us, Jay. Teach us.
It's the 10-year. It's
spread
the 10-year.
between the Fed fund rates on average and the mortgage rate. So if Fed funds rate are at 3.5, then mortgage rates are at X, according to.
I literally was looking that graph up right now.
So this was my newsletter 2 weeks ago where I wrote about this.
You have a newsletter?
And so essentially, the historic spread between the federal funds rate and the 10-year Treasury is about 1.6%, and the historic delta between the 10-year Treasury and MBS or mortgage rates is about 1.4%. So historically, and again, there's a lot of variation, and we're not in normal times right now, but historically speaking, the difference between the federal funds rate and mortgage rates is about 3%. And so even if we get down, assuming things go back to normal, even if we get down to, let's call it 3% in the federal funds rate, that puts mortgage rates at 6%. If we get down to 2.75, maybe we get into the mid 5s. But I don't think over the next 5 years, unless we see some major economic event that forces the Fed to drop rates back to zero, I don't think we're seeing mortgage rates below 5.5% for the next 5 years.
I totally agree. That's we're not I don't want us to go below 5.5. Yeah.
So when Fed funds rate go to 0.25, then that means mortgage will be about a 3.25.
Yes, if
Got it. I just want to make sure.
Yeah, but Jay, you talked about the neutral rate before. So yeah, I just put this graph up of the 30-year mortgage rate and the 10-year Treasury, and you could see how big the spread is right now and how historically it hasn't been that.
Mm-hmm. Yeah, we have about, depending on what you calculate, about 75 to 80 basis points just in spread compression possible, in 2025.
Do you think I'm going to keep asking questions because this is my selfish time. Do you think the product's already out there, but do you think that if affordability continues to be an issue, that the government will either force or the banks will start coming out with longer duration mortgage
40
rate.
year
Well, I
mortgage.
think there was already a few 40s, but like, why can't they come out with a 100-year mortgage to get the payment down? And does that even make a difference? Because at some point you're paying all interest anyway. So even if you have a 1,000-year mortgage, you still got to pay interest only.
I don't know, Jay. It's your show.
I mean, the government has a long-standing history of implementing temporary programs that just sneak into being the new normal. And
Yeah, so I don't really care about duration, right? Of 30 or 40 year. I hope 40 years don't become the standard. I mean, it's already crazy to think you could be 30 years old and you're not paying it off. We do know that the average duration is 8 years before you refi or sell. I don't think 40 or 50 or 100 makes that much a difference. Just get interest only if that's what you want to do. But I do think what you just brought up about the government getting in the way, that could be a problem. You want to really screw up housing? I mean, like really screw it up? Go start giving $10,000, $15,000, $20,000 away in down payment money to first-time home buyers? You want to see housing do something stupid?
are we going there, guys?
If you want to talk about it, that will be ungood. That will be unhealthy.
We gotta get Kamala and Trump in here somewhere. We gotta get the SEO going, right?
Well, so I'm going to pivot this back because we do have to wrap it up. We're getting a little bit longer, and so I'm going to ask if the opposite is true. So we've kind of gone through about how hard it is to buy properties right now. So does that imply as well that it's a good time to sell? So the question is that, you know, I've always had as good practice that every year you should look at your market and your properties and look at what they're worth now and look at what they're spewing off in cash flow now. And would you buy that same situation again right now? And if not, should you be considering selling that? So if the opposite's true right now, and let's say you don't have a locked in, 3%, 4% mortgage, you have kind of an investor loan that you were implying before that does move a little bit, would now be a good time to be selling these single family houses?
Well, again, I think we have a very bifurcated housing market. I think if you have a property that's below the median for your area is very much an entry level housing. That's the scarcest thing on the planet right now. So if that's what you have, clean it up, pretty it up. You got to get, the renter stink off of it. So you got to, paint it, get a new countertop, whatever. Pretty easy to sell. But if you have a busted Airbnb that you bought above the median on some beach in some area, dude, that's going to be tough to sell. So I think it's really about what inventory you are holding. I think right now we are starving for entry-level housing. And if that's what you own as a landlord, congratulations, you have the unicorn. But if you have something above the median that you thought was going to be some super sexy vacation thing, tough to sell.
Well, I got one last question and then I'll shut up.
Can I answer that one?
Oh yeah, sure. You're the pro. Go ahead.
No, so and let me be clear. I love this conversation because it's nice having Michael here because he's a hell of a lot smarter than I am in economics, and he also has been following the single family market a whole lot more than I have. I'm a multifamily guy now, but basically, what I would add to that is when you sell a house, it's not like you can sell a house today and buy it back for 10% less next month and make 10%. When I sell a house today, I'm probably paying 6% in realtor commission. I'm probably paying a percentage or two in closing costs. Then when I buy it back, I'm paying a percentage or two in closing costs, plus inspection costs, plus appraisal costs, plus transfer taxes. I'm spending 10, 11, 12% of the value of that house just to sell it and buy it back. So unless I can, and don't even get me started on taxes, but even
reset the taxes. Yeah.
Yeah. So, but even ignoring taxes, I'm taking a 10, 11, 12% hit on selling a house and buying it back. So unless that property has gone down 10, 11, 12% in value, I'm not making money by selling today and buying lower later. And what's 10 or 11 or 12%? Well, that was basically the drop we saw in 2008 across a national level. And we don't see that.
Or I didn't say sell now and buy again. You could just sell now and make the jump to multifamily, right? Like multifamily prices are down 20 to 25%. We didn't see that correction in single family. Maybe this is the time. Maybe it's the time.
Well, I'll tell you that because that's actually my plan. So I don't know if you guys read my book or know anything about it, but the really big thing that set Olivia and I up to retire early was 2006. We went and saw Bruce Norris, who told us there was going to be a California crash. And I didn't know the guy from Adam. He talked about a whole bunch of big fancy words that I didn't understand, but I was smart enough to take notes and research. And he talked about this thing called the affordability index. And I researched the affordability index for Fresno, California, my market. And I sold all my houses in 1031 into apartment buildings. So we went from 8 houses to 80 units in about 9 months. So I bring that story up again because I've told my audience, I plan to sell my entry-level housing probably 2025, 2026. Hopefully, because the government gets involved and gives me an extra 10% bump. But also all of these busted syndications and these stupid bridge loans and all these other, we're starting to see Class A trade, but Class B and Class C aren't trading yet. That stuff will trade in late 25 and 2026. I plan to move all of my monster equity from single family entry level back into multifamily, and I own a lot more than 8 homes today. So that's my plan for, second half 25, 26. If that was a joke, that is absolutely what I'm doing. I'll do it again.
Well, it wasn't a joke. Our timeline's a little bit quicker than yours, but it's better. Like, it's much safer to be late than early. But it wasn't a joke. That's same thing. The whole reason that we got into multifamily was, to take advantage of what we thought was a growing market, and we've seen that correction. We've talked about a previous podcast on length.
Yeah,
we've seen that.
The hardest time to be a multifamily landlord, in my experience, you know what year it was? 2006. You know why I say that? Because I routinely declined tenants for credit and income, and they bought a home. Think about that.
Well, it's funny you saying that, because we're having more and more right now. We don't have an issue with people applying for our properties. We have more people applying for our properties than we've ever had. But we have a lot bigger issue right now, people qualifying for a few of our properties.
Yeah, but the little twist is they were buying homes. They would call us up and laugh at us. You declined me, ha ha. I bought a new home, blah, blah, blah. But again, that was just, that's how bad it was. And again, the reason I bring that up is because multi-values fell. I took all this extra equity from homes, dropped it on multifamily, and, cash flow exploded, wealth exploded. So we're going to do it again.
Yeah, and this is part of the reason why I'm not going to say bearish on single family rentals, but still a little bit concerned and think now is a tough time. And again, I'm not telling anybody not to buy now. If the numbers work, if you can make some cash flow, if you have some reserves, go for it. But it's not as good a time as it's been. Part of that is that what we're seeing nationwide is a lot of us as landlords in the multi-space and in the single family space, we have this criteria that says we need our tenants to make at least 3 times as much in income as they pay in rent. So if the rent is $2,000 a month, we need their income to be $6,000 a month. Well, nationwide, we are approaching on average 31% of income being paid to rent. The 3-to-1 number means 33%. So once we get from 31 to 33% on average, that means on average, nobody qualifies for our housing anymore. And so we're getting into this situation where, one, we don't have a lot of people who qualify because people aren't making enough money. Wage growth hasn't kept up with the growth in rents. And number two, even those that do qualify, it doesn't allow us to raise rent very much because we're getting so close to that 33% number that even if we raise rent 1%, 2%, we may be able to find tenants now. But if we raise rent a couple percent, we're not going to be able to find tenants pretty soon. So it doesn't allow us to grow rents as quickly as we're seeing expenses grow. Expenses are growing, obviously, at least at the rate of inflation, 3%, but rents likely aren't going to grow 3% for the next couple of years.
I agree 100%.
I don't want to get into it, but I disagree.
Yeah, well, hold on a second. I did see a stat though, and I was trying to pull it up. I think it's almost a third now that there's a stat that shows how many people are paying 50% of their income or more on rent, and that number is going higher and higher.
As far as rents, though, not growing, I think you're discounting too much the cliff of new supply that just when the interest rates went up, and all of a sudden all multifamily starts just stopped. Everything just stopped. people pulled permits, and so the permits like still kind of showed up as, oh, these starts are going to happen, but they never followed through. And we are going to have that. It's going to take a little while because this is, multifamily is a long cycle as far as building is concerned. It's 18 to 24 months. So it's going to take a little while, but that's coming. And when that comes, and all of a sudden the new supply is not keeping up with the demand and the absorption rates, then we're going to see a big spike right then. So that's just something I think people should pay attention to. It's not there right now,
but again, are you like? I mean, I know you don't control this. This is your wife who is our asset manager. But do you think Ashley is suddenly going to say we no longer need that 3 times rent and income to qualify? Are we now going to make it 2.5 times? Because
but it's also you have to be. You're right, and we have to be strategic about, okay, if we know that's coming, what types of properties are we going to buy? What's that's going to affect? Obviously, C class, you're going to have issues with that, right? Like you're going to have a lot more issues with tenants qualifying. But if you're buying, let's say, A class properties in a thriving area where it's renters by choice, then that's not as big of an issue. Or the B class is kind of in the middle, as long as it's kind of the higher end B class, where you can have the trickle down from the A class. Like you just have to be a little bit more selective in the types of property, in my opinion, that you're going to pick. If you know that that's what's going to happen, you're going to have the squeeze from the top because you're not going to have the new supply at the top.
I actually got a question for you guys. This is a quiz I often bring up with real estate guys. So obviously we've seen what people call the fastest interest rate increase we've ever seen, right? We've gone from basically 0 to 5.25, now down to 4 3/4. We actually did do something similar in the early 80s. Now, this is very, very single family oriented. So again, not your guys' wheelhouse, but you're in the game. So I'm going to ask this. A lot of people ask me, how long is housing going to be broken? Because I've been telling people the Fed broke housing. They killed a move up buyer. Turnover is going to collapse, all of those things. And everybody wants it to be over tomorrow. But I want to ask you guys a question. In 1978, we did roughly 4 million existing home sales. From 1979 onwards, we did not approach 4 million. Guess how many years it took to get back to 4 million in existing home sales?
I assume it's a huge number by the fact that you're even asking the question. So I'm going to say a decade.
I'm going to say it's even longer than that because, and here's my rationale. I don't know the answer, but my rationale is that I know that the amount of supply that we add is much, much, much lower than that. And so unless people are moving, unless rentals are taking a large share of that, there's just not enough houses to go around to sell that many houses in a year, given the amount of new supply that comes online. So I'm going to say at least 20 years, 25 years. I'm going to say it was like 2004, 5, 6.
Have we ever gotten back to 4 million?
Yeah, we did. We just did 3.86. So we've been above 4 million for a long time. In recent years. So the answer is 1996. It took 18 years. And the reason I bring that up is everybody wants the housing market, especially real estate agents and all these folks, just to get back to normal. But I want people to realize this air pocket that the Fed created by giving, 85% of people rates below 3, it's just collapsed the move-up buyer. And the move-up buyer is so important to existing home sales because they are both a seller and a buyer. So every move-up buyer that leaves is 2 transactions. So we are not going to go back to historical norms, most recently at 5 million or 5.3, probably the rest of the decade. So the housing market is going to be historically slow. I think appreciation, because again, I hope rates don't go below 4.5. They're probably going to be 5.7, 5.8 for hopefully years. It's just going to be a slow grind.
You don't have to worry about that, Zuber, because first-time home buyers, if Kamala Harris wins, they're going to get $25,000 in down payments. So those move-up buyers, it's just going to be solved. So I wouldn't worry about it.
Well, if let's just pretend that happened for a minute. I don't know how they pay for it and all that, but government doesn't matter, I guess. I think home prices go up 10%. If that happens. at least.
I mean, it's going to be a sliding scale, right? But to those houses that you're talking about that are the starter homes down at the bottom, like the three, like in our area, like I mean, I guess our area you can't get anything, but if you go move, a half hour out and the $300,000 starter home, that's going to be 350 like that, like in a matter of months. All right, I think we're going to wrap this up. Let's go to a top 10, shall we?
Can we spare Zuber the top 10? Can we
No, I got a
spare
good
him?
one here because it's very
Top 10 nicknames for Michael Zuber.
Oh my God.
Okay, so we've got Zuber, we've got Zoobs, we got Z Dog, we got MZ, we got
Michael.
Z Dubs, Z Dub.
I don't want you to start riffing here, and because those are the only ones we came up, and I could tell you're just racking your brain. I got to cut it off right here. No, I'm going to do a top 10 because it is in relation to what we're talking about and housing affordability, and we're going to talk price to rent ratios. So the point is that yes, it's unaffordable in some areas, but there are probably some other areas that it's a little bit more affordable to be doing single family rentals. So just for reference, the price to rent ratio nationally right now is 14.3. If you want to look a year ago, that was 13.9. It was up to 15.1 3 years ago. And 5 years ago, it was down at 13. So we've kind of had a bit of a roller coaster there. But I'm going to do the top 10 cheapest ones because we're real estate investors. That's probably what everyone cares about. But just for reference, if you want to go all the way down to the bottom, this is top 50 metros. San Jose, California, Mauricio, what do you think the price rent ratio is?
And I'm trying to figure out the price raise rent of my house is off the charts. But go ahead.
It is on average 37.6 to 1. There you go.
It's that NVIDIA money.
Yeah, exactly.
Meaning the price that you're doing. So it's the price. Yeah, so the price is 37.1 more than the rent.
I assume it's annual rent, and so annual rent is probably about $3,000 a month, so 36,000, and then 30 sometimes that, so about 1.2, 1.3 million is the average house in San Jose.
The California really dominates those top three there, with Los Angeles at 26, San Francisco at 30, and San Jose at 37. Seattle though still pretty high, 25. Salt Lake City 25. Anyway, we're doing the other side. So the other side, we go number 10, Indianapolis 13.9, Cincinnati, St. Louis, Detroit, Birmingham. They're all in the 13s, and then we get down in the 12s. Memphis 12.9, New Orleans 12.8, Chicago 12.1, and then we sneak into 11s. Pittsburgh, Steeltown 11.9, and number one, any guesses?
Omaha.
This place rocks.
Oh, Cleveland.
Cleveland, Ohio 11.0. So there you go.
Mine is 43.
So if you want to get real simple, those are the places you should buy if you're looking for single family rentals. But obviously it is not that simple. All right, quick. Would you rather? I thought this was an interesting one that I saw someone post the other day. Would you rather have the unlimited ability to raise money? So but at current market returns, you can't just be like at 0%. Like you got to still pay whatever but like if you had a syndication right now in our sense, and we're paying 14%, we could just done. No problem. We could raise money whenever we want. Or unlimited access to loans that are 1% less than competition. I'll start with you, Jay.
So would I rather have unlimited access to debt or equity is basically how I'm interpreting
cheap debt or unlimited
cheaper debt or regular equity.
Right. Because we do have unlimited access to debt. Let's be honest. It's just what's the price of it?
Yeah. That's a hard one. I'm going to go with the debt because I think if we can get access to reasonable, like lower than average debt, we can probably raise a whole lot of equity.
True. All right. Zoobs, what do you think?
Yeah, that's where my mind went as well. If you have a competitive advantage in the debt market of 100 basis points, it's going to make the marginal deals that much better. It's going to be materially different, when you pitch to clients. So I think a competitive advantage on debt makes it easier to raise if you're a good operator.
For sure. Mauricio, you going to agree with them?
The only thing better than having a super smart guy on this podcast is having a super smart guy that agrees with me.
And you just stay quiet when he doesn't.
I'm going to take the opposite because on the raising capital, you said I could get an unlimited amount of that. So that to me sounds amazing. 1% less, that's great. But if I can only, it's not. If you gave me an unlimited amount of debt at less than 1%, is that what you said? I don't think you said unlimited amount of debt at 1%. I could just get debt at less
unlimited
than 1%.
amount, but it's 1% less than normal rates.
Then I would do the debt for sure. That's a no brainer.
Well, of course, I have to disagree with you because if we're talking about unlimited ability to raise money, you want to talk about swimming in blue oceans versus red oceans. If I could raise $100 million, no problem, like the flick of a finger, then all of a sudden I'm looking at, 100 million, 500 million, $600 million properties, and I'm only competing with the big institutions that have that kind of money that are going after that. And like our margins are so much better. And like we could do as many deals as we wanted. And right now raising capital is not easy. So,
but on the other one, I can get $100 trillion worth of debt at 1% below and then flip it.
We still need to find a deal that works. And so I got to find.
Everyone's going to want my debt for. I can have $100 trillion and lend it out at 1% more. I have a 1% spread built in.
Hey, Kyle, do you take the equity option if there's also a condition that if you lose more than 5% of that money, like you go to prison for 10 years?
Why are you adding conditions? I made the conditions. You can't
because then of course you take all the money in the world, you bet on everything. And
I didn't say buy bad deals. I'm saying right now we are competing with a lot of people. There's a lot of people who
size matters. Is that what your wife says?
Yeah,
Size matters.
There's a lot of people who can buy sub $50 million properties. Yeah. And there's not very many people who can buy 100 million plus properties.
So you want to compete with Blackstone instead of your neighborhood barber.
You're like analyzing it rationally with a complete unrational premise. And it's like, look, I could just run Ponzi schemes all day long. I can go do an investment. And if I need to get bailed out, I could just raise another $100 million and bail myself out.
I'm saying it is harder to get deals and it's tighter margins because we are swimming in a red ocean right now with how many people are competing for the same deals. And once you get up above the clouds, then the deals are much easier. The economies of scale, everything's much easier. The problem is that Jay, I don't know. I guess we've never tried, but I'm pretty sure you can't raise $100 million in 2 months. So like we can't compete up there. And what I'm saying is we could make as a group, you have to buy one $600 million property a year for us to do very well versus now you got to buy multiple $30, $20 million properties.
I mean, maybe if you find a deal, we can test that theory.
Yeah. I don't suspect, I put Jonathan Gray, who's the real estate guy at Blackstone, kind of on my Mount Rushmore of real estate investors. I don't think I would look forward to competing with 7 or 8 Jonathan Grays just because we're the only 10 guys that could play with $100 million. I think those are, you talk about red, blue oceans. Those guys don't mess around. I think you might be underappreciating just how nasty and sharky those guys are.
Because they can raise an unlimited amount of money.
You can pay cash. Yeah. You want to play a game.
Right. And that's why they're worth so much money because there's no one to compete with them. That's why they do so well. You don't want to be that person. Like when you say you don't want to compete with them, we are those people if you have unlimited access to capital.
And the crazy thing is the reason they can pay cash today is because they did have access to basically unlimited equity in the past.
Correct. Yeah, that's correct. Yeah. I see your point. I would not look forward to that competition.
Well, I'm not saying that I would do it. My wife would be all over that shit. It would make her happy to run a multi-billion-dollar company.
Would she stick around?
She had that much money.
She still needs somebody to watch the kids.
And she doesn't even know how to order dinner. She called in the middle of this podcast to try and order Honey Grow because she doesn't know how to do it. There's stuff that I make myself valuable. Don't worry.
You got some value.
All right, plugs. Zoobs, thanks for joining us, man. We had a lot of time, or a really good time. We got to do this again for sure.
Oh, I'll be here for you guys anytime. I love just authentic conversations about real stuff where we agree and disagree. I think the most important thing I'm trying to build right now is a #1 real estate investing community on School. Obviously, Alex Hormozi's platform. Currently ranked #4 out of 1,800. We're doing unique content every week, lives, boot camps, all of that in there. Again, my goal is to grow the middle class. My goal is to create a legacy that outlives me by 50 years. So I'm not some grifter out there charge $100 a month. I charge $20 a month, just enough to keep away the trolls, but cheap enough where anybody could join. So my focus is becoming the #1 school community on School. So currently #4 out of 1,200.
Nice.
Awesome. I'm sure Jay will be more than willing to give you his time and help you out with that. Right, Jay?
Absolutely.
Hey, Jay was one of my first guests on my YouTube channel back in the day. I remember following up with him. He's like, all right, you're persistent. I'll give you an hour.
Jay, you got a plug for us?
Yeah, I'm going to plug this book right here. It's called One Rental at a Time by a gentleman named Michael Zuber. And it's even autographed. Look at that. Look at that. And I'm going to do another one really quick for anybody that wants to get on meaning the Drunk Real Estate's daily economic newsletter. Basically, we only give you the top 3, 4, 5 headlines of the day with a few sentences of commentary, just so you can wake up and in 3 minutes know all the important stuff that's going on in the economy, real estate, politics, business, technology. Go to DRE, as in Drunk Real Estate, DREdaily.com and sign up and join the other 600, 700 people that have signed up in the last 2 weeks.
Awesome. Mauricio, you got a book you want to plug too, or what do you got?
I'm going to plug One Rental at a Time, the YouTube channel. Mike Zoobs, for somehow, how many, you literally do like 7 videos a day. Like, I know you go live a lot, and it's just really amazing the amount of content that you put out every single day. So if you're
him and George Gammon, like you just can't keep.
Yeah, he just busted out. So One Rental at a Time on YouTube.
14,000 videos, baby. 14,000 videos, right there.
Hey, Zoobs, who does all your thumbnails?
I pay a guy in Mexico that does the thumbnails.
That's a lot of thumbnails.
Yeah, it is 5 or 6 a day.
Full-time job. I love how I made Zoobs a thing. Like he's like, call me Zuber, and I was like, I'm calling you Zoobs. It reminds me of my old hockey agent Doobs, and everyone just kind of jumped on that train and started calling you Zoobs. So. All right. I would plug you too, but I can't. I have to plug my wife. It's kind of my thing. I love plugging my wife every night, so I'm going to plug her again.
That's why you married her, I'm thinking.
That's right. Go check out Badass Investor on Instagram, Badass Investor on YouTube. She has about 1/100th of the videos of One Rental at a Time. So you'll be through the entire catalog much quicker. That's all I got. Hey guys, I had fun. It was good.
It was awesome.
Yeah, thanks, Mike, for coming on, and really enjoyed it.
Yeah, that speech, Jay, about keeping this shorter and doing shorter segments had absolutely no effect. So let's we'll try it again next week. All right, guys. My drink is gone. I'm gonna go hit the head. So I will see you next Tuesday.
See you guys.
See ya.